Good morning, everybody. Welcome to the Reserve Bank's Monetary Policy Statement press conference. The Reserve Bank wishes, first of all, to extend its sincere sympathies to all of those who were affected by the earthquake in Christchurch. Our very special condolences go to all of those who have lost family or friends or colleagues in that event. The Reserve Bank this morning is cutting the official cash rate by 50 basis points to 2.5%. The earthquake has, of course, caused substantial damage to property and buildings and immense disruption to business activity. And it is still very difficult to know how large and how long-lasting these effects will be. But it is clear that economic activity has been very significantly negatively impacted, certainly in Christchurch, but also nationwide as well. Even before the earthquake, we were seeing growth in the second half of last year that had been much weaker than expected. Households had continued very cautious. Retail spending volumes had been declining and residential investment had been declining as well. Of course, at the same time, the export sector has benefited from very high commodity prices, but generally farmers have focused on repaying debt, and the early summer drought that we had also constrained farm output. We were recording signs that the economy was starting to pick up early this year, but that, of course, has been more than offset by the Christchurch earthquake. This monetary policy statement does rely on many key assumptions, and it's based on very limited information compared to what we would normally have. We will therefore inevitably be retesting our judgments as new economic data comes to hand. For now, we have a forecast where we see the growth in GDP as being weaker through the first half of this year, but this will gradually build up to a very large reconstruction program by 2012 that will last for some years and that will contribute to a period of relatively strong activity in New Zealand. Our future monetary policy adjustments will be guided by emerging economic data. We expect that the current monetary policy accommodation will need to be removed once the rebuilding phase materialises, but we warn that this will take some time. For now, we have acted preemptively in cutting the official cash rate in order to lessen the economic impact of the earthquake and to guard against the risk of this impact becoming more severe. Thank you, ladies and gentlemen. That's the end of the statement. We're happy to answer any questions. To assist, I've got Dr. John McDermott, Assistant Governor, Head of Economics, and Dean Ford, Head of Forecasting. Any questions? Sorry, can we wait for the mic, please? Thank you.
You previously indicated that interest rates would be unlikely to move before next year. Is that still your expectation?
Well, as usual, we do have a 90-day interest rate track in the forecasts, and you'll draw your own judgments off that. We currently have a 90-day track forecast which starts off much softer than it was before, and then by 2012 returns roughly to where it was before.
How do you rate the chances of a major oil shock, and how would it complicate your task going forward?
Well, the prospect of a major world oil shock does complicate things in a significant way. We do have to remember, despite the fact we've had a huge domestic shock, that there are a number of international events of relevance. One, of course, has been that our trading partners are growing a little faster and forecast to grow a little faster than we had anticipated. But at the same time, there's considerable disruption going on around the oil markets. And I don't think anyone is in a position yet to know quite where that goes. We have factored in our forecast something like $110 Dubai price it's slightly over that at the moment. Were that to continue at these higher levels, then that would impact on inflation in our forecasts. That's just something we're going to have to keep judging as we wait for events to stabilise.
How strong do you expect the offsetting effect on activity and discretionary spending to be, though, if oil prices persist at these levels? Would it even out, do you think, or would the inflationary effect be more of a concern than the effect on activity?
Oh, ultimately, if oil prices stayed up at these high levels, we'd have more inflation from it, and we would also have some contractionary effect from it. That hasn't been enough at this point to feed in directly in a major way into our forecasts, and neither have we got it feeding into our trading partner forecasts either. But were we to see a real resumption of very high oil prices, then it's got to have an impact.
Dr. Ballard, I had a question about the December GDP, because you mentioned in the statement that you thought it would be steady. And given that GDP contracted in the September quarter, are you expecting a contraction in the December when you talk about steady?
We're talking roughly flat numbers. You'll notice there's actually a little less quarterly information in this monetary policy forecast. To be realistic, we had to make a decision only a week or so ago whether we would put out a forecast at all. There are some huge assumptions in here, and you'll have to interpret it in that light. We decided it wasn't particularly useful to put out quarterly data as a result of that. We believe we've got a flat period through there. It could easily move around positive or negative. It's going to be complicated by a shortage of information coming from economic statistics as a result of Statistics New Zealand's Christchurch operations. That's the reality.
Did you give any consideration to an emergency cut to get the stimulus flowing as quickly as possible? And if not, why not?
Yes, we did. We met immediately and through the period, the days after the earthquake. We decided that wouldn't have any particular immediate desirable effects and could be a little bit dangerous given that the news coming through at that stage was very incomplete. We decided we lost nothing by waiting to get more information through to be able to do a proper forecast and make up our minds on that basis.
You mentioned short-term price increases following the earthquake. Can you elaborate on that? What should people be preparing for?
Well, what we do comment on is the fact that it's inevitable there will be some price increases. We've talked about rents and about insurance price increases, some of which will be measured through in the first quarter of the year. In addition, there's things like bottled water and so on that are very scarce and where one could see price increases. Those sort of things we think are very temporary. We look through those. We don't adjust monetary policy to those. We're more focused on the medium term.
Dr. Bollard, I'm just wondering if you've had any feedback from the banks about mortgage problems in Christchurch with people walking away from their homes and giving up, saying that they're not going to continue paying their mortgages.
Well, of course, one of the things we do is regulate the banking system, and we have been quite active in talking to the banks about how they're seeing the risk of impairments either in the residential or commercial sector. They're all going around at the minute working out the extent to which they need to make special provisions for any increase in failure to repay mortgages or loans. Their experience after the first earthquake, admittedly a much more mild affair, was that there wasn't very much. Their view is that they are making provisions, but we and they are confident those are quite limited. In terms of people walking away from mortgages, no, we're not hearing very much in a sense. I suspect it's small businesses that are actually more vulnerable in terms of loans they've taken out.
We've been experiencing extremely low levels of household credit growth for a long time now. Do you have any views on what the impacts of that is on the macroeconomic situation?
Well, that's been a feature that a number of OECD countries have been seeing since the crisis, and it basically shows how cautious households are and how they're really focused on deleveraging, retiring debt, reducing mortgages. And that, in a way, has been Not a puzzle for us, but we've had difficulty understanding just how much and how long that would continue. That's been a prime driver of the reason for softness through the second half of last year. We expect that to see slow increases in credit growth this year, quite apart from the earthquakes effect, which will obviously impact as well.
Have you had any consultation with the banks about whether or not this will be cut will be passed on in floating rates?
We, of course, don't talk to the banks about what we're going to do. We do test this time, as we do every time we test with the banks, ranges of options and scenarios to try and build up for our information what might be the consequence of cutting or not cutting. We do that every time. We would expect to see a lot, if not all of this OCR cut pass through.
There's some fairly public nudges from across the road over the last week on interest rate cuts. Did you feel pressured at all?
Would you like to be more specific, Rob?
From the Prime Minister's strong hints on interest rate moves?
Well, I mean, we observed and read what the Prime Minister said. Actually, he said that he read what the markets were saying and repeated that. We've had no pressure from the Prime Minister or the Minister of Finance at all on this matter. So, no, we haven't felt pressured about that. But I would like to say one thing, which is we have changed our process a little bit this time, given that we are in a state of national emergency. And in view of that, it was my view that we should consult with the Minister of Finance and coordinate as much as possible our views on monetary conditions and the Minister's views on fiscal responses and other packages, in order that New Zealand is getting the best in a coordinated way from both sides of the economic agency spectrum. And that's what we've done. Now, that is unusual, but the decision is entirely mine, and the responsibility for it remains mine. We would expect that to be a one-off while this state of emergency lasts.
You commented in your introduction that there's less information to go on at the moment than usual. And this is a thinner MPS than usual, and there's less information in it as well. That seems like slightly unusual circumstances. We have the same, I mean, the statistics releases are just being delayed. They're not being cancelled. And we've had a whole lot of statistical releases which admittedly have surprised the markets. Have they been surprising the Reserve Bank? Is that what you're saying about the lack of information, the lack of predictable information, or the lack of actual information?
Well, we had an earthquake. We haven't seen this before. It's a massive event. We are not sure how it impacts the economy. We're trying to reflect that through in what we've done. We weren't sure that we would be able to actually do a forecast until a week ago. We believed at that stage we could form a judgment that would be useful. It's only a judgment based on assumptions. You can see in the box there what those assumptions are. They will change. We won't be right on that. Those numbers will move around a lot. It's pretty important you interpret it in that general sense.
But a lot of the uncertainty that we're seeing in these forecasts is a result of stuff that predated the earthquake. I mean, there was a lack of clarity prior to the earthquake taking place.
No, I wouldn't say that. We have, quite apart from the earthquake, changed our view to a much softer, flatter second half of last year. But that's really the only significant change that went on. But that's far surpassed by the economic effects of the earthquake.
So your business visits were before the quake were suggesting a bit more buoyancy out there, and there's been some pickup in business credit. How concerned were you that the quake itself would set that back, that business sentiment and investment story?
Well, we are concerned that it shouldn't set that back, and that is one very specific reason why we've cut rates by 50 points today. It's inevitable that there just be a degree of caution and worry across the whole economy as a result of that, even in sectors that aren't directly impacted. We have put this cut in place today to help counter that, and we hope and expect it will have some effect in helping restore that sort of business confidence.
Dr. Bullard, do you think there's a risk of a double whammy on inflation in 18 months to 2 years' time as the impact of this monetary policy easing comes through at the same time as the rebuilding inflation impact in Christchurch and around New Zealand?
Well, I think we've all got a challenge for the next couple of years as this rebuilding takes place. It's a massive rebuilding. It's sort of roughly 4 times Christchurch's normal building program. We believe the earthquake effect on our current numbers does something like adds 2.5% growth next year. It's very significant by New Zealand standards. So I think we've all got a challenge here, and the challenge is first of all a depressed and disrupted year this year, but then some years of quite strong growth. So there is a risk. And that's why we're just going to have to be very alert to the economic numbers that come through. We have, on the other hand, observed pretty moderate inflation coming through from the GST increase. That's all happened in a pretty orderly sort of way. Inflation expectations have looked pretty anchored. That's given us some confidence that we can actually cut today, but we will have to remove some of that accommodation at some stage.
How much extra traction does the move in floating mortgages give you, and ability to spin on a dime, if you like, and reverse back the cut if you need to?
Well, I don't know about spin on a dime exactly, but I think the fact that now most New Zealanders are on floating or pretty close to floating mortgage rates when they're borrowing does mean that there's quite a lot more flexibility on monetary policy. And when the time comes to tighten, we've got some confidence that monetary policy will have significant traction as a result of that.
Are you worried too internationally that central banks will be too slow to tighten monetary policy if inflation gets going, as we're seeing with commodity prices?
Well, Bernard, you know the old Libyan proverb that a man doesn't laugh at another man's camel. Are there any more questions? Good. Oh, go on, Nigel.
You mentioned in the statement that any capacity problems that the building industry might have further down the track could be alleviated by overseas workers. How confident are you, though, that, say, in Australia, workers will come here for lower wages, presumably?
Well, I mean, that's really an issue for the government more broadly. We're just raising the fact that there will be resource constraints. There will be pressure and bottlenecks with this size construction project, not this year, but over the next couple of years. And the government, no doubt, will be thinking creatively about what it can do there. Australia is not the only source of skilled labour in the world. There's a lot of excess construction capacity around both developed countries and emerging markets.
So are you calling for some sort of relaxation of immigration rules or requirements?
No, we're simply pointing out that there will be these big resource constraints, and it's one of the many things the government's going to have to think about in the reconstruction program.
You mentioned that things had been slowing down before the earthquake. Would you have cut or see the need for a cut if the earthquake hadn't happened?
Well, you know, that's a hypothetical. We don't know that, but we certainly had some change in our forecasts. The second half of last year had not eventuated as strongly as we expected. It hadn't eventuated strongly at all. That was a surprise that was shared by most businesses in New Zealand. If you look at the business opinion surveys, where you can measure what people expected and then what actually happened, it's actually been a surprise that's been shared in a number of OECD countries as well, where broadly speaking the private engines of growth didn't take over as strongly from government stimulus after the crisis early last year as we had all expected. So we would have had to consider a significantly softer starting position and what was appropriate for that. But I'm sorry, I can't actually answer your question.
There's been talk of perhaps tens of thousands of people leaving Christchurch and moving to other cities, whether permanently or temporarily. Do you have concerns that this could reignite housing markets elsewhere, perhaps in the South Island, but even more broadly?
Well, we have to see what happens in that, and there will be short-term rental pressures. We can already see those, but we're not taking a position that says medium-term that has an impact, nor indeed that medium-term there is a net population outshift. So I think that's one of the things we'll have to wait and watch. We do observe that the New Zealand Herald's been making a lot of noise about rental pressures in Auckland. We're not seeing those so much in the data, actually. While the Christchurch effect could impact it short term, we suspect that'll be a short term effect. But we do need to remember that we felt there was, quite apart from the earthquake, there was room for more residential investment this year, next year, in other parts of New Zealand. So that will be happening anyway.
What do you say to those retirees who now are going to get a significant cut in their income from term deposits, those in Christchurch and elsewhere?
Well, I mean, they know these interest rates go up and go down. Generally speaking, New Zealand depositors have been getting pretty good returns back from deposits with more interest from the banks and funding their books from them. I think a lot of that will continue, so this is just one of those things they're going to have to look at, and as we've said, we expect that the accommodation that we've put in place today will need to be removed at some stage, so they'll have to take their own views about that.
And in previous monetary policy statements, you've spoken about fiscal policy and the need to tighten. Is that need not there anymore?
Fiscal policy is going to have a dominant impact, and that is a response to the Christchurch earthquake, and it's up to the government to work out how best to do that. We've got some assumptions in our forecasts about that, but it's up to the government to design and announce their policies.
Given the state of this, the degree of this turmoil, how crucial is it for the export sector and commodity prices to stay strong to help the country through this?
Well, of course, the export sector is pretty advantaged at the minute, getting extremely good commodity prices, and actually at the minute getting the benefit of the softer New Zealand dollar as well. So the export sector is doing well. Now, we don't tend to hear them making a lot of noise as a result of that, but let's remember that part of New Zealand is doing very well out of that and is likely, we think, to continue to do well out of that. And of course that's important for New Zealand. We haven't necessarily seen a lot of that extra spending going around the high street yet as farmers reduce their debt to banks, but we do expect to see that start to happen this year.
To what degree is it offsetting the negative impact of the earthquake and the fragility of the rest of the economy?
I'd say to a significant extent. If we had poor commodity prices at this stage and poor terms of trade, New Zealand would be in a much worse position, but we're fortunate that we're not. There seems to be strong continued demand for our produce. We're forecasting that to continue, even though we know it's always volatile. That does make it much easier for us to get through this earthquake event. Thank you, ladies and gentlemen. Thanks for coming.